Welcome to this explainer. We're going to take the often dense, math-heavy world of cost accounting and turn it into something that actually makes sense. We'll uncover how businesses make sure they aren't just making products, but actually turning a real profit. If you've ever wondered how companies figure out the perfect price tab without, just flying blind, well, you're absolutely in the right place. Let's get into it. Think about this for a second. Imagine someone baking a birthday cake, and they want to figure out exactly how much that single cake costs to make. They can't just guess, right? They literally have to add up every single pinch of flour and sugar, the exact cost of the eggs, the gas for the oven, and yes, even place a dollar value on their own time. This everyday problem, figuring out exactly what goes into creating one single item, that's the beating heart of our entire topic today. So here's our roadmap for today. We're going to cover 1. What is cost accounting? 2. Tracking materials and labor. 3. The invisible factory overheads. 4. Building the cost sheet. And finally, 5. Choosing a costing method. Section 1. What is cost accounting? All right, so to know exactly what that birthday cake cost, we've got to track every single penny. And that is exactly what cost accounting is. It's this rigorous process of recording, classifying, and analyzing literally all the costs that go into making a product or providing a service. Precision is the name of the game here. A business has to know exactly what something costs so management can fix the right selling price, figure out what's actually making the money, and basically stop throwing cash down the drain on wasteful expenses. Now, you might be wondering how this differs from regular accounting. Well, financial accounting is for the outside world. It tells the bank or the tax man about the bakery's overall profit at the end of the year. Cost accounting? That's an internal tool. It tells the bakery manager exactly how much the chocolate cake costs compared to the vanilla one. It's super flexible, highly detailed, and completely focused on the internal gears of the business. Section 2. Tracking materials and labor. Okay, so before we even bake our metaphorical cake, we've got to buy the ingredients. But here's a massive dilemma. How much should a factory buy at once? Order too often and your ordering costs absolutely skyrocket. But buy too much in bulk and your storage costs eat up all your profits. Enter the economic order quantity, or EOK formula. It beautifully resolves this tension. You take the square root of 2 times the annual demand, multiply that by the ordering costs, and divide by the carrying cost. Boom, you find the magic number. It might tell you that ordering exactly 1,000 units at a time is the absolute cheapest way to keep the factory running without overflowing your warehouse. Now, once all those materials are actually sitting in the warehouse, market prices are probably going to fluctuate. So when the factory finally uses them, what price do we actually record? Well, there are 2 really common methods here. First up is FIFO, which stands for first in, first out. Think of this exactly like grabbing the oldest milk in your fridge first. You use up the oldest, earliest price stock, which leaves your remaining inventory valued way closer to the latest market prices. Alternatively, you've got the weighted average method. This recalculates a fresh average price for all your stock every single time you make a new purchase. It's a fantastic trick to smooth out those wild market fluctuations over time. Moving on to human labor. This is super interesting. How exactly do we reward our workers for getting things done faster than expected? We use incentive schemes like the Halsey and Rowan premium plans. Let's say a worker saves 2 hours on a 10-hour job. Under the Halsey plan, they get a flat 50% bonus on the time they saved, which might mean an extra 50 rupees. But the Rowan plan, that calculates the bonus proportionally based on the total time allowed. It scales up way more generously, paying out an 80 rupee bonus for those exact same 2 hours saved. Pretty crazy difference, right? Section 3. The invisible factory overheads. So, overheads, like electricity or rent, aren't tied directly to one specific product, which means we have to meticulously assign them using a 3-step process. Think of it just like splitting a massive pizza bill with your friends. Step 1 is allocation. That's when a cost belongs entirely to one person, or in a business, one department. Step 2 is apportionment. This is for shared costs, kind of like splitting the cost of garlic bread based on how much everyone ate. In a factory, you'd apportion rent based on the floor space each department takes up. Finally, step 3 is absorption. This is where we take all those allocated and apportioned costs and charge them directly into the individual product's final cost using a specific mathematical rate. Here's the catch, though. That overhead absorption rate,
It's usually just an estimate based on budgeted hours. But what happens if reality doesn't quite match the budget? Let's say your factory actually racked up 11,000 rupees in overhead costs, but your formula only absorbed 105,000 into the products you actually made. Well, you've got an underabsorption of 5,000 rupees. That means 5,000 rupees less was charged to your products than what you actually spent out of pocket. You absolutely have to account for this shortfall, otherwise you're going to think you're turning a profit when you're actually losing money.
Section 4. Building the cost sheet. All right, let's pull all this together. Every single cost a business incurs falls into one of these building blocks. The direct costs, that's your materials, labor, and direct expenses, they form the core. Then, wrapping around that core, we have our invisible overheads, the factory overheads, office and administration overheads, and, of course, selling and distribution. They all stack up together to create the total amount you spend before you ever make a single dime of profit. Watching this cascading flow in practice is honestly kind of magical. Let's trace it out. We start by adding our direct materials, labor, and expenses to get a foundational prime cost of 85,000 rupees. Next, we stack our factory overheads. On top of that, bringing our factory costs to 99,000. Add in the office overheads, and we reach a cost of production of 109,000. Finally, tossing in our selling and distribution overheads brings us to our ultimate cost of sales at 113,000 rupees. It's only after we know that precise number that we can safely add our desired profit margin, landing us securely at our final sales figure of 150,000 rupees. Section 5. Choosing a costing method.
So, how do we apply all of this? Well, it depends on the business. First up is job costing. You use this when production is based on very specific, totally unique customer orders. Think bespoke birthday cakes or a tailor making a custom suit. Every single product is distinct. Because of that, you use job costing to maintain a separate cost sheet, tracking the exact, unique materials and specific labor hours dedicated to that one single item.
But what if you're building a massive bridge or maybe a cargo ship that takes several years to finish? That's where contract costing comes in. Since these projects drag on for a long time, claiming all your expected profit early on is super dangerous. Contract costing makes you play it incredibly safe. You calculate what's called a notional profit based on the work officially certified by engineers so far, and you cautiously transfer only a fraction of that, say 2/3, to your actual profit and loss account. The rest, you keep it as a reserve, just in case things go sideways later. Now, if you're running a chemical plant or a sugar factory with continuous identical output, you'd use process costing. Here, costs are tracked across different stages, and the system automatically absorbs normal, totally expected losses, like liquid evaporating, straight into the cost of the good units. And finally, we have activity-based costing, or ABC. Instead of using one lazy blanket rate for your overheads, ABC is smart. It assigns overheads based on the actual activities that drove the costs up. For instance, it'll accurately charge a product based on the exact number of complex machine setups it actually required. By really understanding cost accounting, you kind of unlock a completely new way to look at the world of business. You start to realize that a price tag is never just a random number someone made up. It's this meticulously constructed tower of direct costs, human labor, and carefully absorbed factory overheads. It definitely leaves you wondering the next time you buy something, exactly how much of this price tag is for the physical product in my hands, and how much is just the invisible cost of keeping the factory lights on.